Hi everyone, my name's Daryl Payne, CEO at As Good As Gold Australia. Once again, I'm joined by my brother Brian and partner at As Good As Gold.
Thank you, Daryl.
And this morning we interviewed David Morgan from the Morgan Report, an advisor to As Good As Gold Australia. Good morning, David.
Morning.
Good morning, David.
We've got plenty to talk about today.
Absolutely.
As is normally the case. Mm-hmm. But I thought before we started on that journey, what we might do is acknowledge to our viewing audience that we're gluttons for punishment here, Brian. Going back, and I'm sure you know what I'm referring to, going back about a month ago, we did a promo and we offered gold at spot, which of course we've never been able to obtain as customers. No. But now we're offering it to the world, right? So
it does work like that.
So we thought we'd do it again, didn't we? So I'd like to explain how it works. If you go to our website at www.asgoodasgoldoz.com.au and click on the international link, that'll take you over to the products that are available to ship in the US and Canada. So what you have to do is place an order online. Let's say it's for 50 silver coins of your choice. They could be Maples, Philharmonics, Kangaroos, Britannias. Once you've added them to your cart, you go back to the international product page and order a gold coin from the exact same mint as the silver coins. So if you picked, say for an example, if you've ordered 50 silver kangaroos, you place an order for a gold kangaroo. So once that's been added to your cart, the price will automatically drop down to spot. Now, the promo runs till midnight, Friday, October 15th. That's a week from now. For the moment, I need to confirm that we can only accept bank wire as a form of payment. Now, we are working diligently,
very hard,
right, on this, and we're anticipating that we'll be able to provide more payment options in the not too distant future. But stay with us on this, guys, because it remains a really great deal. Gold at spot. The offer was never there when we were clients.
No, I've never bought gold at spot. Bugger.
So, having said that, I'd like to raise my first question, David. It's gold and silver been going sideways and have been for a while now in like $1.50 range, up $1.50, down $1.50, up $1.50, down $1.50. You can see it's monotonous regularity, isn't it?
A little.
Yeah, so I'm thinking to myself, what is it going to take? What is it going to take to push gold, silver prices considerably higher? And I was listening the other day to a gentleman by the name of Steve Penny, publisher of the Silver Chartist Report. Very positive on silver. And he was asked that question, what would it take to see silver in particular go rapidly to another level? And he said, like, there's a number of catalysts that could create that environment. But he said the one that stands out at the moment most to him is a stock market correction. So he said a 20% stock market correction would do it. That would do it. He said there would be a considerable rush into the precious metals industry. So currently calls for a stock market correction are beginning to blow through Wall Street. You've got Deutsche Bank, Morgan Stanley, Goldman Sachs. They're all saying that don't be surprised if there is at least a correction, minimum of 10%, from the horse's mouth, basically. So,
and those guys are very conservative. So.
Correct, but this is the message that's that's out there at the moment. So my question to you, David, could Steve Penny be on the money here? Do you think that's all it would take? Because right now the stock market is pretty vulnerable. It's pretty volatile. It's up 500, down a couple of, down 500, up a couple of hundred, down 500, up a couple hundred points. So what are your thoughts at the moment? Is Steve Penny right? And do you think, that might be the trigger?
First of all, let me shout out to Steve Penny because I met him for the first time at the Silver Symposium last week on the 27th and 28th of September. And as you said, he writes the Silver Chartist, bright young man. It was a real pleasure to, get to know him a little bit and have a little bit of a discussion with him. Yeah, he's right on. I mean, there's it reminds me of an article that was written by a friend of mine in the financial money management business, very articulate, very well studied silver bull. And he wrote an article called Silver, ... waiting for a catalyst. And there's several potential catalysts, but the one that Steve referred to, a 20% drop in the stock market, is probably the most valid as far as being sure that it will launch the metals, because gold is the most negatively correlated asset to the stock market. So a run to gold will automatically start, and that would mean that silver, being the poor man's gold, would follow suit, or in fact, it could even anticipate a fall in the stock market. So I think that's probably the best, as I said, assurance of an event that you could pick that would pretty much guarantee a move into the metals that would take it beyond these very interesting ranges that it's been range bound in for some time.
And so what do you think the likelihood is of a correction to that extent? With the fluctuations we're seeing at the moment, I mean, and we've seen the last 4 or 5 nights, as I said, down 500, up 200, down 500, up 200. I think more than ever right now, there is anticipation that we may see this major correction real soon.
Yeah, it's really tough, Daryl and Brian, because it's pretty apparent that we've been in, a high level area, making new highs in the U.S. stock markets for some time. And there are no normal market conditions anymore, and there haven't been for a very, very long time. And we have pretty much what we call in the United States and around the world the Fed put, meaning that the powers that be, known as like the plunge protection team, which composes of, it's formerly the Working Group on Financial Markets. It's the head of the SEC, the CFTC. I mean, all these big power players that basically have access to digital money when it's required to keep the stock market from falling too far. So I could make an argument it will never happen, because these people can print, money at will and always feed it into the market. And with the algorithms there to really protect the upward momentum of the stock market, you start to get a big sell-off, and then the circuit breakers are what they're referred to. And it's a good analogy, because when you pop a circuit breaker on an automobile or on a home or a factory, it cuts the circuit off and nothing happens. It ceases. So a circuit breaker in the stock market, all trading halts. And it halts off, I think the first one's for 2 hours. And then everybody gets to gather their thoughts or whatever. They put the circuit breaker back in, and trading resumes. So I was of the opinion as early or as recently, let's say as a year and a half ago, that we would see a correction. And then I started to refine my viewpoint that perhaps the ability of the money manipulators to keep this thing going indefinitely could possibly be the case. And the reason I say that is the word I don't use very often, and that's hyperinflation. So in a hyperinflationary environment, you could have a stock market that keeps going higher and higher and higher. I mean, what stock market was the best 2 years ago, or maybe 3? Zimbabwe. Zimbabwe had the best performing stock market. Why? Depreciation of the currency. So would the United States depreciate the currency at such a rate that the stock market would be one of the only places that people that don't understand money move their assets into because it's better than keeping it in the bank? And the answer is yes, that possibility exists. Now, coming full circle, I'm talking out of both sides of my mouth, and I'm not running for mayor. I think it's still likely that we would see a correction. And the reason is that even with the algorithms and the circuit breakers and everything I just described, there is sort of a financial reckoning or a financial mother nature, if you will. And you could get into a situation where, let's say there's a real problem in the debt markets. And I know we're going to talk about that in a moment or two. And the debt markets are at least 300% bigger than the financial markets. And that would spill over into the stock market. They're very correlated now. The bond and stock markets used to be negatively correlated like gold is, but not anymore. They're pretty well correlated. So something that happened in a big way in the debt market and started to get a pension fund to start moving a lot of money the wrong way, or the wrong way for what the market expected it to take place. And all of a sudden, an algorithm that's watching that pension fund move that kind of money, and then Fidelity says, oh my goodness, the algorithm for Fidelity, it works their bond desk. I mean, there's a person there, but it's a math equation, and it moves. So either scenario could happen. I think that we're probably more likely to see a stock market correction than the scenario of an ever expanding monetary base that feeds the stock market into infinity. What's really sad is the more morally correct is to let the market clear, which means to price stocks what they're really worth, which is far lower than they are right now. If you do keep expanding the money supply and there's a rapid run into a parabolic move in the stock market, you've destroyed the currency. You have lost faith, totally lost trust in the ability for the banking system / government to have any control on the money supply, or the value of the money, I should say. Very, very scary times either way. But I would much rather see a 20% correction, or let's say let the market clear to whatever that is, which could be more than 20%, and take the pain
hit. Yes.
And have something that we could still trust and work with, than to print funny money into oblivion and everybody has to give up because we know the game's over. It's totally worthless.
Yeah, governments don't like taking the hit, do they?
No, never have. They always kick the can down the road.
But eventually, of course, you pay the price, the ultimate price.
Further you kick it down the road,
at that point. Yeah. All about winning votes and getting another term in office, isn't it? No one wants to own up to them being responsible for taking the economy down.
Yeah, I'll let the net president handle the situation.
That's right. Still on silver, David. In March last year, silver gold ratio hit around 130 to 1, which was, I believe, a historical record. August of the same year closed into 65 to 1. I can remember Brian and I talking to our clients and saying, get in on silver at this point at 130 odd to 1. It was just ridiculous and couldn't be maintained. And that's in fact what happened. Closed in pretty sharply to 65, and now it's sitting just under 80 to 1. Now, 1980, the ratio was 15 to 1. Gold, around 800, silver, $50. 2011, another debacle, of course, 2007-8 through to 2011. Silver gold ratio, 33 to 1. My question to you, David, is do you believe that we are likely to see that silver gold ratio close into anywhere near those numbers again, 33, 15 to 1. What are your thoughts?
I do. Of course, I am, biased towards silver, but I'm also a good, market student, not just the metals markets, market psychology, hyperinflations, crumbling of empires, and all of that. So since there is so little silver relative to gold on a value basis, I mean, all the financial markets combined, gold represents less than 1% of all the financial system. But silver only represents 0.02%. So if you want to see gold really surge, 2% of the population moves into gold instead of 1%. But if you want to see silver explode, then that 0.02% goes to 1% or goes to 0.5%. So that's a lot bigger multiple. So, and silver, of course, be more affordable. So I think you will see a halving again. Silver will double, redouble, and double again, meaning you'll see the ratio go from 80 to 40 to 20, and perhaps even to 10. And the reason being is what I said. There's so little silver, and there'll be such a demand for anything that is a safe haven. And silver right now is, even by some of the major commentators, it's not money and it's not this or it's not that. You can be whatever you want. If I could just digress a bit with you, Daryl and Brian, I'd like to just give you a little bit of my presentation from the Silver Symposium.
Yes.
And I started off, in fact, I'll just digress slightly. It was part of my presentation. I actually did this video that was nothing to do with silver or the markets. It just had to do with the predicament that we're in. It was a gentleman that sent a postcard from 1969, and he went through the stress that he and his father had breaking down on the highway, and this cowboy stopped by and helped him out. I won't go through it. That's kind of beside the point, but I just try to put the big picture out that, look, we're all human beings. We should treat each other well. And it was an illustration of how people really are. So I'll leave it at that. Mm-hmm. So coming on point, the next slide, I started talking about why silver is not money. And I had not, all caps, underlined. And here's the slide. In the United States, as of 2019, there were 157 million workers. And the average workday in the United States is 8.8 hours. And the average wage in the United States is $26.17 an hour. So now we get to do some real simple arithmetic. Why silver is not money. You take 150 million, so I rounded that down a little bit, times 8 hours, so I rounded that down a little bit, and you get 1.2 billion man hours. Now remember, the average wage was $26, which is about an ounce of silver. So for 1 day's labor in the United States only, it would take 1.2 billion ounces of silver to pay everybody just 1 day's wages,
right,
in silver. And we both know, we all know, that the max silver that we have obtained in the last several years is 1 billion ounces on an annual basis. Yeah. And that's about 850 million ounces mined and about 150 million ounces recycled for 1 billion ounces. So 1 year's total silver supply, counting recycled and mined silver, is 20% short of paying the US. Now, the next slide came up with some very interesting questions. If that is true, which it is, how could it be that we could be on a silver dollar standard for 400 years?
A little bit of manipulation.
The idea of how undervalued silver is.
Yeah.
So if you want to explore that a little more, and I will, and I'll turn this around and interview you guys a little bit.
Yeah.
So if you go back to when my dad was a young man, I was a toddler, 2-3-year-old. his wage was about 5,000 a year, but that was before the change of currency. So he could have taken his script and turned it into silver when I was a young kid. So 5,000 units, $5,000 is really about 4,000 ounces, by the way, because a dollar by weight is about 3/4 of an ounce, as you both know. But regardless of the fine details, 2 cars, my mom didn't work, new washer dryer. I mean, we weren't living like a super high lifestyle, but we were comfortable, on just one working on a silver standard, more or less. I mean, silver was still in circulation. You could still take that, it wasn't a federal, it was printed by the federal, it was a silver certificate is what it was. So my point is that about $1 a day for a wage earner, $1 a day, meaning a silver dollar a day. Okay. That would be 360 ounces or roughly in a year, would be something that you go back in a couple generations before my dad, that would be, a standard wage. And then you go all the way to the Roman Empire, and 1/10 of an ounce of silver would be a day's wage. Okay. So right now, let's say at $20 an hour, which is, I'm rounding up a little bit. Well, the average thing was 26. So if I use 20 at 8-hour days, that would be 160. So that would say an ounce of silver would be about 160 at a $20, So the point is, and maybe I'm jumbling this all up, I don't mean to, as silver is so far undervalued,
Sure.
that it's just ridiculous. And yet when it was valued as money for hundreds of years, if not thousands of years, because I went on to talk about silver really started out in the Sumerians as their unit of account was silver, not gold. But anyway, I don't want to digress too far. The point is, if silver was thought of as money, and I did a lecture on that about 3 years ago, several times, what if silver was treated like gold? What if silver was treated as money by the banks instead of dissed off as it's only an industrial commodity? What would it be worth? And the answer is about 1/15 the price of gold usually. That's what it would be worth. So that was hopefully thought-provoking for our interview this morning, and also maybe for you to contemplate. Does that mean silver is going to be money again? Doesn't have to be. That's the point. I mean, palladium doesn't sit there and ask, am I money or not? There's just such a demand for such a scarce commodity that's absolutely needed in catalytic converters. The price went from the hundreds of dollars per ounce and sitting around 2,000 per ounce and stays there pretty much. Silver could do that based on industrial need, and then monetary demand on top of it could push it far, far higher. So still bullish on it, still think that 50-to-1 ratio is achievable without a lot of effort once the shift in consciousness changes. I mean, everyone that's a silver investor pretty much knows why they own it. The problem with our industry, as you both know, is lack of exposure, lack of knowledge. People don't know what the reason they own it is. They know they own Tesla because Elon Musk is cool and everybody else owns Tesla. And this is the kind of reasoning that you have in the markets now.
Do you know who's going to watch this interview at least a dozen times? John Adams.
Yes, yeah,
Now,
John Adams.
let me share the reason why. I get asked the question many times, David, as you would, as Brian does. What do you recommend so far as a ratio, gold to silver? Now, I'm very pro-silver, as you are, and I'm 80-20. Brian's very similar, I believe, yeah?
Yeah, pretty close.
Yeah,
Pretty close.
80-20. Do you know John Adams? And you know John pretty well. You speak with him regularly.
Wow.
John is 99.99% silver. Right? He did have 2 ounces of gold a long time ago. He's down to 1 ounce of gold now because he lost the other ounce to my PA in a bet going back some time ago. But he's going to love this presentation, I can assure you. It confirms everything that John's been committed to for the last few years. Right.
There, that's quite incredible. I love your explanations on silver, David. I could listen to it all day long. But unfortunately, one of the, it's not unfortunately, but I have always been a gold standard person when it comes to the money supply. And although I know silver, I believe silver is money, gold and silver is money, and that's what you save in. But today I'm going to talk about a book that I read. It's called Why Gold? Why Now? I'm going to make a few statements. But before I make those statements, I'm just going to read you out a quote, which I think is pretty right up to the mark. So the quote says, and I don't know the author of this quote, but it is very important that we all listen to it. A government big enough to give you everything you want is a government big enough to take away everything that you have. So just remember that one, folks. When we go to the polls next time, just to make sure that what the government is really doing to us. Now, David, after reading this book, I also went back to my history on the price of goods and services of using gold and using the price in currency. And this is A, B, and C. The first one will be the cost of a motor car relative to currency and gold, the cost of a home using the same process, and a savings plan. All right. And I want you to comment more so on the savings plan, David, than the other two, but you'll get my point after I bring the facts together. So I'm going to go back to 1985. So we're talking about 35, close enough to 45 years. But 1985, and we're talking in Australia, but you can bounce it back to the American dollar. So a General Motors Ford or General Motors car in 1985 in Australia was $11,800. And that was the equivalent in gold. If you had 24.6 ounces of gold, you had the equivalent to buy that car outright. So that was 1985. Now this is all about how gold preserves the value. They're always preserving your value. So we moved from 1985 to 2012. That Ford or General Motors car would cost you in Australia $35,000. So it's jumped from $11,800 to $35,000. And it's gone from 24.6 ounces of gold down to 23 ounces of gold. Moving forward again to 2015, another 3 years, and that motor car in Australia was $39,000. And in gold, interesting enough, it went up. So in gold, it went from 23 ounces to 27.4 ounces of gold. Now, interesting in currency terms, the price of the motor car between 2085 and 2015, 1985 to 2015, the increase was 230% increase. The increase in gold, 11%. Holding pretty good value. Now, let's take these figures back a little bit, and we go to the Model T Ford, or equivalent to a General Motors Holden, but we all know what a Model T Ford was when that was built. 1908 was when they reached 100,000 vehicles per year. So it was a reasonable good volume. And the Model T Ford started at $365. Now today, that Ford or General Motors Holden is $40,000. But isn't it interesting? That $40,000 from $365 is a large percentage. I'll let you know what that is. But in gold terms, the Model T Ford started off at 18 ounces of gold for $365, 18 ounces of gold. But today, it's 17 ounces of gold. 17. It's come down minus 0.5 of 1%. But in currency, that Model T to the present day Holden or Ford is plus 10,500% increase, as against 0.5% decrease in gold. So that's the facts and figures of manufacturing, not only in Australia, but probably in America and Germany and throughout Europe. Gold always prevails as the stable money supply. Now, I will add that Jim Rickard says that the price of gold should not be the price it is today. And he's always talked about 10,000 US gold, 40% backing. If we did 40% backing today of gold, the price of that motor car would not be 18 ounces of gold or 17. It would be 3 ounces of gold. That's the productivity you would actually see from manufacturing around the world if money was gold. Now, a lot of people ask us about real estate. Real estate's an interesting thing because there's a lot of government controls on the land, but there's not a lot of government controls on actually building the home. So what I did is I took a price. We live in Adelaide, and I took the price of a Adelaide home. I couldn't get the figures back to 1908, so I had to start somewhere. It was 20 years ago in the year 2000. So these figures are 2000 to 2021 this year. Price of a home in 2000 in Adelaide, median price throughout Adelaide was $135,000. Today, 21 years later, it is $550,000. But let's look at it in gold. 20 years ago, it cost you 320 ounces of gold to buy that home. Today, 241, much less. So the value is always in saving in gold and silver. Jim Rickard's, as I said, $10,000 gold. That's 13,000 Australian, by the way. Now, that price of the home in Adelaide, in gold, if we had a gold standard, or at least a backing of 40%, 42 ounces of gold. You know, you got to look at the facts and the figures. You got to see what is the best currency. Best currency. Is it fiat or is it gold and silver? So, the last point, which is my point C, David, and I'd like you to comment. I've got down here a savings plan that no government can take from you. If you're saving in gold and silver, right, in the physical, not the paper, don't worry about ETFs and this sort of thing. If you're saving in physical silver and physical gold, I'll guarantee you if you do it right, there's a savings plan that nobody can take away from you. No government, no financial institutions. You do it right and they'll never be able to take what you've saved. So, David, your comments.
If I was on the mainstream financial channel as an interviewer, and you just said on that channel what you just eloquently stated to, whoever's going to watch this video, you'd probably have a run to gold because you just succinctly stated why everyone that knows anything about money, finance, or investing would own gold. But that's why you never hear someone like you on there. You might get a commentator like me on there, but they've already got the deck is stacked, In fact, the last time, and I will answer your question. The last time I was on CNBC, they actually wanted the questions ahead of time or my thoughts ahead of time, and they basically did a spin meister on it. The question was, is gold in a bubble? And the price of gold was just going to 1,000 an ounce US. And they wanted to know. And I kind of got blasted by their spin meisters. And so I interjected right before the end of the segment that gold was not in a bubble. It had a lot further to go. The only thing in the bubble was the bond market. But there's about a 3-second delay. So by the time I got out the word bond, they had technical difficulties and it never went over the So your question, Brian, is I think it's more important what I just said. What we said at the beginning, or I said, is, our people perish for lack of knowledge. I mean, if people had the very succinct knowledge of what you just did with an automobile, long-term, a house in Adelaide, it's so irrefutable that I think a lot of investors that had never thought about gold, but there's so much negative, there's very little objectivity on Wall Street about gold. It's either not talked about or talked about with a very big slant. And then you'll get these articles on, from the mainstream press mainstream financial press, gold's a pet rock. And then I'll get Warren Buffett on there and say why you don't own gold. You just take it out of the ground, stick it in the safe. And, it doesn't, take it from one point in the ground and bury it back in the ground. All these kind of comments, very negative gold. But yet there's been nothing on planet Earth for all of recorded history that preserves wealth like gold. And if you're an investor, you want to preserve wealth. One of the stalwarts of diversification is to make sure if you make a bad choice or there's a problem in an asset class, you've got something on the other end of the teeter-totter that's going to balance out your portfolio. And if you do that analysis, what you find is 25% gold holding is the correct amount for all conditions. Inflation, deflation, stagflation, anything, you need 25%. Now that sounds like a lot to some people. And maybe, but it isn't. It's the derived number. And that is, and I have to qualify it because I want a bunch of rocks coming my way. And if they are rocks, please make them gold ones, okay? That's from 1968 to present day, okay, where we've had more and more distortions in the markets, which means you probably need more and more gold in the portfolio to balance out all the craziness that's going on in the financial system. But my comment, the last part is, don't overthink it. And when you buy gold, know why. And I think anyone that goes through as good as Gold Australia gets a good education on why. I think, if you have somebody brand new, you guys will take the time, one of the staff, to explain it to them. But don't expect it to go up in fiat terms the day you buy it. Realize what Brian has outlined for you, that it does vary, but it is without a doubt the most cherished commodity on the planet and probably always will be. And that doesn't mean you have to be 100% gold bug in order to sleep better at night. And we are in a position now where the run to gold is going to start in earnest. I don't know if it's day after tomorrow. I don't know if it's in 2022. I don't know if it's going to be as long as 2023. My gut and study says it'll start moving rather well by the end of this year. And I'll use silver because I study it more. That, if we get above $30 in silver by the end of the year, that'll be a real strong indicator that we're going to have a really good 2022. And if we don't, we're still going to have a really good 2022. But really, I cannot overemphasize that if we had the ability to take this video and put it at a short course, just do Brian's segment and put it in every high school on every country, translate it into Chinese and German and Italian, and give those kids, that are getting into the workforce, that understanding of how precious metals are called precious for a reason. I don't think you could stop the run to gold. I really don't.
Yeah.
No, so very true. My last question, David, is really about margin debt. So we're talking about the stock market. We brought that up in the beginning, and I just wanted to bring up the margin debt to the figures that I read just recently. Now, by the way, margin debt, in very simplistic terms, is how much the financial institutions would loan you in the stock market on various stocks that you may own. All right, so they'll loan you a nice amount of money, let me tell you. The margin debt, the US margin debt is up. The margin debt is up to $900 billion in the United States from $250 billion in 2009. Now, we know the problems in 2008, 2009. So it is up from $250 billion to $900 billion. David, what have we learnt from the experience of 1929? Printing paper and calling it money. The Fed mentions it has many tools. Well, we've just spoken about silver and gold, and we've spoken about how good it is to save in silver and gold. I think gold and silver is the tool, but of course the Fed believes otherwise. David, your thoughts, please.
Well, it goes back to the question I spent so much time on about, are we going to see a stock market correction or not? And, to put on my conspiracy hat, I don't have it sitting next to me, or I'd wear it. But, if the insiders are positioned where they can benefit from a crash in the stock market, believe me, it'll happen. And that's what happened in 1929. I mean, Barar Baruch, you read some of the books that go through that era, what the insiders were doing. They tipped each other off. They knew what was going to happen. So certainly, we're really overextended. I think the reason, and I'll repeat what I said to you both, was there's so much tied to it that they don't want to hurt, like the pension funds and even the money markets. But they're all in trouble anyway. I mean, the pension funds are overextended. Almost all of the state pensions are underfunded. I forget the number. I think it was last year that state pensions funds on a national basis, in other words, and break it down state by state, was something like 10 billion, or maybe it was 100 billion, I forget, that they just borrowed to pay their retirees. How long can you borrow to pay your pension people, right? And it's only getting worse with Social Security and everything else. I mean, the system really should clear. And that means that things should be repriced according to what the market forces would dictate. But that's something that we could have had happen in 2008, and we didn't let it happen. And now we're in a system where, capitalism is kicked dead and stabbed to death. And why do I say that with such force? Because even all the people that are anti-capitalist don't understand what it is. It's the right to succeed or the right to fail. If you have a bad product or a bad idea or a bad loan or a bad stock and it dies, you pay the price. It's called responsibility. And it went out the window in 2008. And I know we're going to get a question on Evergrande because it's pretty interesting from a geopolitical standpoint, who's the most socialistic, depending on what happens with this Evergrande situation, which I'm not sure, but I've changed my opinion on it somewhat. But I think I answered that question. I am just frustrated, as you can tell. I think that as much as you and I and so many in our field, John Adams, I could name a whole bunch of people, and I won't because I'll leave someone out and they'll be mad at me, that have carried the flag, shouted from the hilltops, and just watched so few really understand the meaning of a fake, false, phony system that's stealing from them on a daily basis. And there's something so simple as picking up the phone, turning fiat into hard currency, and yet they don't do it or won't do it. And most is because they haven't heard the message or haven't heard it correctly.
Yeah, I just have got to reiterate, Darryl, that the Fed keeps on saying it has many tools. I don't need many tools. They only need one. Yeah, that's it. That's all they need. It's got history behind it, 5,000 years behind it. There's only one tool that's necessary, but they won't come up and use it, not just yet anyway. Darryl?
Well, they use one pretty regularly. Yeah.
It's printing of money, yes.
The printing press. David, my final question to yourself in regard to this Evergrande dilemma. Talk about catalysts that could influence the price of gold and silver quite dramatically. Well, Evergrande could quite easily be that catalyst.
House of Cards.
Oh, look, I mentioned with Alastair, when we interviewed Alastair a couple of weeks ago, that Evergrande could just be the tip of the iceberg. I think this is bigger than what a lot of people think. And I think now a lot of people who didn't feel like I did are now starting to believe that, hey, this could be huge. We now have another Chinese developer, Fantasia Holdings, that can't pay their debtors. They've missed a bond payment of $206 million. This represents a total of $315 million in overall payments to lenders. They've fallen short. Now, Fantasia's shares were suspended on Tuesday. As I read it, the outlook for the Chinese property development market is furthest from encouraging. Property sales in the top 30 Chinese cities, this is huge. Property sales in the top 30 Chinese cities plunged 31% in September from a year ago. Imagine this in a global, widespread, situation. So Chinese investors are scared. Banks are pulling in the reins. This is an industry that, mark my words, and we know this anyway, very, very much debt-driven, highly leveraged in China and Australia and all around the world. So the Bank of Mum and Dad has taken a hit just recently. It's increased in popularity by over 70% in the last 12 months. So new home buyers, is mainly new home buyers, of course, can't afford a property. In Australia, you're looking at $500,000-$600,000 for a half reasonable home in a reasonable suburb. And mum and dad are being hit, by their kids for a loan, because a deposit now on a property, $500,000, they're needing $90,000 plus, and the kids don't have it. So mum and dad are committing to it now. I mean, how long can this continue? So, and they're saying, when is this going to ever end? Well, I've got a pretty good idea it's not far away. No. So the lending criteria here and in China really tightening up. I can only see the industry heading in one direction from here. I think the House of Cards is on the brink of collapse. David, what are your thoughts?
Yeah, they've been changing. I had a paid member ask me about Evergrande recently, and my answer to him at that time was very little happens in the political or financial realm by mistake. But I've started to shift my thinking. In fact, it's interesting what you said, Daryl, because you said people are starting to come more toward your point of view, and I'm going to assume what that is. So let's get some facts on the table first, and then we'll start what my thought process is, and we can have a discussion. The most astounding part to me about the whole Chinese situation is that 75% of all investment in China is real estate related.
Yeah. Wow.
Well, you're overweighted real estate. Now, how does that compare to the United States, which is, everybody in the United States almost, I'm probably the one person, I'm joking, but that real estate only goes up. There's nothing better than real estate. Oh, you gold guys have real estate, real estate, real estate. Real estate in the United States is 27.6% of all investment. So China is roughly 3 times more. It's very overweighted real estate. And what are you buying in some of these cases? Well, you're buying what's called a flat. I mean, the UK people will be familiar with that, but it's basically an apartment in a large high rise. A lot of those flats are in what are called ghost cities. These are cities that have no one in them, but there's flats, and you get to invest in real estate by owning some of these. The biggest problem is not only are they overweighted, it's the leverage in the real estate market itself and the inability to make good on the payment, which means default. But it isn't Evergrande that defaults. It isn't Fantasia that defaults. It's all the interconnectedness of all those. And as we talked off air before we started the video, is that's the dominoes. It's, it's not corny. It's a very good illustration that one domino falls and a whole bunch go right after it. And that's the problem. Now, the real thought process that I have used is, will it be rescued or not? At first, when it first happened, I said it's a Bear Stearns moment. It's not a Lehman moment. The analogy there, folks that don't know, is Bear Stearns was a big, big deal for about 3 days. And then it was over. Lehman almost took the system down. So my initial thought in Evergrande was that it was more of a Bear Stearns. It was a lot of hand waving, jumping up and down. Oh, collapse, it's going to happen. And I said, no, I think it's overblown. I don't think it's that big yet. This is inevitable. I mean, whether it's Evergrande or not, after what I say, and Daryl and Brian add to it or, poke holes in it, it's not immaterial. It's very important. But if it's left and the system continues being kicked down the road, it's inevitable. The problem will only get worse. So I think after listening and studying and reading that Xi Jinping is of the mindset to let it fail and to let the banks purge, which is more of a capitalistic idea than a communist or a socialist one. In socialism, nobody fails. Everybody's equal no matter what happens. The big government kisses it, makes it better. I don't think that's the case. I've changed my opinion, Daryl. I think that it is going to teach the speculators a lesson. And a lot of those speculators that are in on it are very, very, very wealthy Chinese. You might call them capitalists in quotation marks. And now if almost everybody in China that invests is invested in real estate. As I said, 75% is real estate. So it's going to hurt a lot of people. I think you're right, Daryl. I do think this could be the beginning of the end for the capital markets, starting in China. Of course, it'll hit the United States. They're all interconnected in some degree. And I don't want to say this, but I thought about it, and usually I contemplate pretty carefully what I speak, but I thought it was absolutely necessary. And I think what's going to happen is war. And the reason I say that is because when the capital markets go into a destruction mode that I see, this South Sea contention that's building and what's going on with Taiwan, I mean, this probably will be a precursor to some type of hot war, not just a cyber war or a rhetoric war or a cold war. It's going to be a real war. And I don't say that with anything but a heavy heart, but it's a lot easier for the political class to talk about how bad the financial conditions are because we're shooting at each other. And I don't rule it out. I'm not wishing that. I really carefully thought, should I or shouldn't I even voice it? But you guys expect me to shoot straight and give my strong opinion. And it's an opinion. I don't know. I don't have any hard facts. I have a lot of history. And the history shows again and again, when you get into these kind of financial conundrums, war is there. So that's my thoughts.
I think you're right, David. And, the more I thought about this, I've just got to agree with you. I don't believe the Chinese government will bail out these companies. That would just be adding fuel to the fire. So I see this as really big news, and it goes way beyond financial institutions. The ramifications extend outwardly. Example, the iron ore industry in Australia, our export market to China is massive. Okay?
Yeah.
I'd hate to see Australia's financial position if you took iron ore out of the equation. This massive amount of construction that's taken place over the last few years has required immense amounts of iron ore from Australia to produce steel for the construction of these buildings. It's all gone. And this will flow over into the construction industry in this country as well. It's not that there's going to be more iron ore for Australia. This is going to send shockwaves through the whole system. And I agree that I think David is right on the money, and it's far more serious than a lot of people are thinking. And gold and silver, of course, it's sad and it is shocking, but gold and silver will prevail in this environment. I have said before, I've given illustrations. David, Brian, you know this. I've done it many times. I've given illustrations of gold versus real estate. Right now, that example could never be presented at a better time. I continue to shock people, David, when I refer to this gold versus real estate illustration, and people who have been in real estate for years say, Daryl, that can't be. Why have I not recognised that? But here is the illustration. I'm going to give it once more. I do this every day, and I shock people every day, but it works like this. If one goes back 20 years ago, 2000, the year 2000, right up until now, gold has averaged 27.1% return. Not compounding, but it's been the average 558% into 20 years, 27.1%. Surprising. So let's say that somebody had invested $500,000 into gold 20 years ago. And let's say they let it sit there for 5 years. It'd be worth well over $1 million. 20% a year, it'd be $1 million, but it's averaged 27.1. So you'd have over $1 million. You could liquidate at that point at 20% per annum, $200,000 a year. The value of your gold would be higher at the end of each year than it was at the beginning of the year. You'd have less gold, but it's increasing in value every year at the average of 27.1%. So you could do that infinitum, and you'd say to yourself, and you'd never run out. You'd never run out of gold. What a fantastic position to be in. Compare it to real estate. Let's say you had that $500,000 property, you bought that, and let's say that you had 5 great years and it increased in value to $1 million. So if you rented that property out, it was an investment to you. The return on that would be around about $40,000 a year before outgoings. If you take them into consideration, you'd be looking at something like a $25,000 to $30,000 a year return versus $200,000 a year if you're into gold. I mean, this is startling, but it's factual. And I keep forwarding out, I've documented all of this and done a complete presentation on this. And people keep asking me for it. When they've read it, they come back to me and say, you've got to be kidding, but it all adds up. So more, I believe, more now than ever before, if you're not into gold, you've got your head in the sand.
Yeah, if you're not in gold, you have a problem.
You have a problem. So just on closing, Jim Sinclair, I've always said Jim Sinclair's right. Of that, there is no question. Jim Sinclair says, just do what the central banks of the world do. Own gold. Why do they own gold? To protect their wealth. Give their currency some sense of value. Just do what they do. Governments, of course, don't want you to do that because they don't want you to have influence and power. But, you need to be in a position not only where you are protected, but you can help those around you that you may love dearly. So that's number one point. And of course, then we've got Egon von Greyerz.
Egon von Greyerz, yeah. Well, we talked about the percentages of gold and silver and what everybody's different. So you make up your own mind. But what Egon von Greyerz has always said about how much does someone put into gold? How much does someone put into gold and silver for their retirement and for their portfolio? Basically, the answer is whatever you can't afford to lose, right? Because every investment is a risk. Daryl?
David, any parting words?
Yeah, I will give you some. I thought about it. First of all, as I said every time, you can go to themorganreport.com and get on our free email list. But I'd like people to know about the blog. And on the blog, at the upper right-hand side, there's several icons. There's one for our YouTube channel, our Twitter feed, and that type of thing. I suggest people go to our YouTube channel. I don't advertise that very much. But when you click on our YouTube channel, there again is a menu left to right. And about the middle, there's something called Community. In the Community tab, I put videos up that I personally vet that I think are really, really important for people to watch. And they usually deal with topics that I'm familiar with, but not an expert in, like the food crisis, the supply chain problem, cyber attacks, geopolitical issues, some stuff about the illness. Now, often what I find is so pertinent to current events that the cancel culture takes them down. So I've had several over the last year that have actually been, the video no longer exists. But I just would like to make people aware of that. I mean, I really think the best that you can have as a work environment is to do something you're really passionate about and that you really love. And really, if that's the case, you don't really ever work a day. Now, certainly I do have days I feel I am working, but overall, I have a real joyful heart for what I, have chosen to do with most of my life. And this is just part of it. And I don't set many up there. It's not like, but it's a time that you can go look at my YouTube channel, look at the community tab, pick out a video or two, watch it on the weekends, and familiarize yourself with what's really going on, because there's a lot going on behind the scenes that you will never hear from the propaganda press. I say propaganda press because it's propaganda. It is not truth. And if you are going to prevail through these extremely difficult times, you're going to have to align yourself with the truth as much as you possibly can. That's my final statement.
Hey, when David was expressing his views there, I thought of Charlie Tremendous Jones again. I never forget his comment, in 10 years' time, you'll be in exactly the same position that you're in right now, apart from two things: people you meet and the books you read. What an opportunity to connect with somebody like David Morgan. I mean, these are opportunities that for most people are rare. But I spoke with somebody the other day who said they had spoken with David on a call. And this is a great thing about communication today. Anything's possible, isn't it? But this particular gentleman had spoken with David for half an hour, and he said the value I got out of that was just immense. So, there's an opportunity here. Like I remember my mentor, Peter Daniels, would say, some people flinch. Can you believe this, David? Some people flinch at taking out a millionaire and buying them lunch. They'd prefer to cut it short and just buy them a coffee. Right? Peter Daniels would say, hey, if you get a chance to connect with a millionaire and someone who lives like a millionaire, or is, somebody that's really achieved something in life, and you can get some valuable information out, buy them a 3-course meal. It doesn't matter what it costs. It's cheap. You're getting all this value, right? So there's an opportunity here for this viewing audience to communicate with people like David Morgan in this situation. Can you imagine how much smarter you will be when you walk away from that discussion? I mean, David's been invaluable for us, hasn't he? And we count our blessings there that we've been able to connect with David. So take advantage of the offer. Go to the Morgan Report, and you will be a better person for it. Thank you, David, once again. Really appreciate your input here at As Good as Gold Australia. Not only that, you're a great friend. We appreciate that. And we, once again, would like to say to all of our viewers and subscribers, thank you so much for continuing to support this channel. And so for now, we'd say stay well, stay focused, and goodbye for now.
Goodbye for now.